Thank you to everybody for joining us today. We're very pleased to report a strong performance ahead of original expectations, and especially given the pandemic headwinds that we've seen over the course of the last year. So a year of real progress for the group, with results ahead of original expectations, as I say, strong financial performance, resulting in another year of growth in revenue and adjusted profit, net cash at year end for the first time, material earnings enhancing acquisitions, which have increased the scale of the group and its capabilities. And the group is in a strong position as we start the new financial year, and we'll see the full benefits of the acquisitions that we've made in the first half of calendar 21 and the expected increase in insolvency activity in the second half of the year. Strong financial track record. So the year we just reported continues what has now become 5 years of very good growth, with adjusted profit before tax and earnings per share more than doubled. Annualized growth rates of 14% in revenue, half of which is organic, and 20% in adjusted EPS, again, half of which is organic, and annualized growth in dividend of 8%. We've made 13 value-enhancing acquisitions during this period, and as I say, we're well placed in the current year to continue this growth. In terms of detail of the numbers we're just reporting, I will pass you over to Nick Taylor, who will go through that with you.
Thank you, Rick. Good morning, everyone. Start on slide 4, looking at the financial highlights of the 12 months. We're reporting revenue growth of 19%, 13% from acquisitions, 6% being organic. That takes our revenue to 83.8 million for the 12-month period, compared to 70.5 in the comparative 12 months. We've improved our operating margins to 14.8%, which reflects the benefits of the scale and insolvency, and we've maintained our central costs as a percentage of revenue. Our adjusted pre-tax profits are up by 25% to 11.5 million from 9.2 million. And that's having absorbed the lockdown profit impact on our property business of 1.3 million this year, having had a hit of 0.6 million in the previous 12 months. And that's having made no claims under any of the government's COVID support schemes. Our adjusted tax rate is down slightly to 20%, giving us a growth in adjusted EPS of 21% to 6.9p, up from 5.7p last year. On the back of that, we are proposing an increase in our dividend of 7% to 3 pence, and that gives us dividend cover of 2.3 times, up from 2 times last year. And we end the year in a net cash position following good operating cash flows over the 12 months. If we turn to slide 5, looking at our 2 operating segments and starting with business recovery and financial advisory. Revenue growth of 20% in the segment, taking revenues to 59.7 million. 14% of that coming from acquisitions. That's both the current year acquisitions and also the full year impact of the acquisitions we did in the previous year. And 6% growth being organic, and that's made up of a strong performance within advisory and also a robust performance within business recovery, and that's despite the suppressed market. Our margins are up to 24.6% in the segment from 23.4 last year, and the graphs on the right of this slide show the progressive increase in segmental profits over the last 3 years. As you'll be aware, we've made significant investments through acquisition in this financial year, CVR and DRP, in the early months of this calendar year. The integration of both of those businesses is now being completed on target, and initial trading's in line with expectations. And we also acquired 2 portfolios of personal insolvency cases in Scotland, which came with a team of 5 fee earners. As I said, it's been a robust performance by our insolvency team against a very challenging market backdrop. As we've reported previously, the insolvency market has been suppressed over the last 15 months since the start of the pandemic. The government support and legislation changes, that's given us a decrease of about 34% in national insolvency appointments over the 12 months to March 2021. In which period there were just over 11,000, which is the lowest level of corporate appointments we've seen since 1989. In spite of that, our forward order book of committed insolvency revenue, that's non-contingent insolvency fees, is up by 49% to just over 28 million at the end of this year. And that growth coming from the acquisitions which we've brought into the business. And we've maintained our organic order book over the last 12 months. So on an organic basis, we enter the new year in a stronger position as we were 12 months ago. And that's despite the market drop in activity levels and with the benefit of the increase in scale from the acquisitions on top. Our year-end headcount has increased due to the acquisitions, an extra 161 people in the insolvency business, with 159 of that coming from the acquisitions we completed. And we move to slide 6, our property advisory and transactional services business, where we saw revenues grow by 15%, 9% coming from acquisitions. Again, that was current and prior year, full year impact of prior year acquisitions. We've had some good organic performance, and that was offset by the impact of the lockdown in the first quarter of this year. Margins, unsurprisingly, impacted by that lockdown impact, down to 16.2%. And we believe that our revenue was down by about 1.7 million, profits by about 1.3 from the levels we would typically expect to see from this business. It was our commercial property agency, valuation and auctions teams, together with business sales agencies, that were impacted. We first saw that come through at the back end of the comparative period as we first went into lockdown, and that continued into the Q1 of this financial year. We then saw activity levels improve over the course of the year, and then that returned to pre-lockdown normal levels in the final quarter. It was a robust organic performance overall. Our plant and machinery auction business and our insurance teams increased their activity levels year on year, and our consultancy and property management teams remain broadly in line with the prior year. And as we previously reported, building consultancy showed a strong growth. Significant increase in funding we've secured for our education sector clients, 28 million of funding from the government to enable the schools and colleges to upgrade their premises, which was a 50% increase on the prior year. And our fees from this activity increased to 2.2 million from 1 million in the comparative period. A small acquisition at the back end of the year, a London-based practice called HNG, property management, an agency and lease advisory team that's building on our London team, which we already had in place, and that's performed in line with expectations. And the integration of that business is planned to start in the new financial year, having completed the CVR and DRP integrations. And year-end headcounts up by 25 to 306, with 13 joining through acquisition. On slide 7, a reminder of the 4 acquisitions that we've completed relatively recently, all in this calendar year. You'll remember the CVR and DRP are the significant insolvency acquisitions, all the key terms and numbers detailed on the slide, just to remind you of where we are with those. And Rick will go through the operational and commercial benefits coming from those acquisitions. I'll just draw your attention to the MAF Finance Group, which came in at the start of the new financial year, just to point out that the consideration on this transaction is far more heavily weighted to earn-out than we would typically see, and that reflects the growth targets which we have in place for the business. And we believe this business has significant growth potential, and the earn-out is structured to recognise and reward that should the business meet those targets, to grow to an average pre-tax profit of 2 million by the end of year 4. The integration projects for all of these are on target, either completed or underway, and financial performance is in line with expectations. We start our new financial year in a strong financial position with significant liquidity. We have increased free cash flow, which is principally coming from the improvements in operating profits over the 12 months, and also a favourable working capital movement compared to the prior year. We completed a fundraising of 22 million. That's 20.9 million net of expenses, which we completed in March 2021. And that was made up of the vendor placing of 10 million to fund the DRP acquisition, and a cash placing of 12 million. 10 million come from institutions and 2 million from retail investors, which we completed through the primary bid platform. And our acquisition and deferred payments in the year of 23.9 million was made up of current year acquisitions of 20.9 and deferred payments of 3 million. Looking forwards, we have deferred consideration payments, which we expect to pay over the new financial year of just over 5 million, which is well covered by our anticipated free cash flow. And the details of future year payments are detailed on slide 27 in the appendix to this presentation. We've got significant liquidity in our committed facilities. We've started our year with net cash of 3 million. That compares to an opening net debt position of 12 months previously. And a reminder of those facilities, it's a 25 million revolving credit facility. We're only utilising 5 million of that at the start of the year. There's a further 5 million unsecured acquisition growth facility, and those facilities mature in August of 2023. And on slide 9, our outlook. We start the new financial year in a strong position. We are well positioned to deliver the anticipated material growth in earnings. The drivers of that growth, the full year impact of the acquisitions we completed in the final quarter of financial year 21. The MAF Finance Group, which came in at the start of the new financial year. We'd expect to see growth and recovery in the insolvency market. We'd expect to see that start to come through from the second half as the various government support measures start to be removed. And we anticipate that normal trading activity in property services will be maintained, and that leaves us well placed to deliver growth in both profits and margins year on year in the property segment. And overall, we anticipate our results will have a greater second half weighting as we see that recovery in insolvency come through and benefit our results. And we'll give a further update on activity levels at the AGM in September. I'll now hand back to Rick to talk through the operating and strategic review.
Thank you, Nick. We've already talked briefly about the insolvency markets, significant headwinds for us with overall appointments down 34% across the country. I'm pleased to say that we somewhat bucked that trend with our appointments down just 12%, but in terms of value, we maintained a flat level. So the mix of work favoured some larger jobs, which meant over the year we were not materially impacted by that fall in insolvency. Clearly, the reasons for the reduced numbers is the government support measures, which were quite rightly put in place, the furlough scheme, soft loans, and prohibition on various types of court-related action by creditors, both trade creditors and also landlords. Those measures are due to unwind over the course of the next 6 or 8 months, starting at the end of September with the removal of the furlough scheme and also some of the restrictions on winding up petitions. So the potential catalyst for growth in this market, which we're expecting to see in the second half, is principally the reduction in those government support measures, but also generally the opening up of the economy as well, and businesses having to make tough decisions. We've already just started to see something of a trend. The government statistics for appointments were recently announced for the second quarter of the year, and the appointments in June were up to the level they were in June 19, and we have certainly seen that in our business. And anecdotally, our appointments so far in July would suggest that that trend is continuing. So we do anticipate a busier second half, and that's based on increase in the number of liquidations, administrations, and other general voluntary insolvency procedures. Moving on to slide 12. As we've said, a robust performance in a challenging environment, and that increase in organic fee income from larger cases offset the volume reduction for the smaller cases. There is a graph here which you can look at your leisure, but very simply, if you look at the 2021 columns, you'll see the dark green column, which is the increase in activity in larger cases. That's with fees of more than 50,000. And the blue bar on top of that is the increase in advisory fees with cases more than 50,000. Looking at particular high profile and larger appointments, the Wigan Athletic Football Club, which we were appointed on and traded for a season and have successfully sold. The the Football Index, which is the online football gaming site, and two significant retailers, Brooks Brothers UK and Ralph and Russo, their fashion chain. Both the Football Index and those retail jobs came from our recent acquisitions, which shows the increased quality of work that we're generating from a larger London office. The financial advisory business had a successful year with increased corporate finance income following some exceptional deal completions. And we've seen a progressive increase in insolvency market share in recent years, moving from 8% in 2018 to 12% in the year that's just gone. Moving to slide 13. Significant increase in scale and capability of the business following the transformative acquisitions that we completed earlier in this calendar year. And divisional revenue has increased by 40% on the back of these. And particularly that's shown a material increase in the scale in our key London marketplace, where many bigger jobs are originated. The annual fee income of our London office increased to 28 million from 13 million. That's the run rate. And the enlarged London office team is 26 partners and is now a very significant market participant in the mid-market. These acquisitions also enhanced our advisory capabilities, including forensic accounting and pensions advisory. Those services help with restructuring and investigative insolvencies, as well as non-insolvency advisory activities. And for the first time, we have offshore practices. We have 6 offices around the world focusing on insolvency and advisory work. And the first significant success story from those offices is the Football and Index case, which was originated from our Gibraltar office. We're also very pleased that MAF Finance Group has joined us. That was acquired just after the year end. This is a finance brokerage business which specifically arranges funding for specific assets. So that's property, plant, machinery, fleets of motor vehicles, IT kit, etc. It deepens our existing relationships with banks and other lenders. It passed over 150 million of lending activities to banks over the course of last year. And it is anticipated as that business grows, that number will increase significantly. And these acquisitions have given us the capability to deliver significant growth in revenue and profits in the current year and beyond. Moving on to slide 14, a look at our property services. It's a broad portfolio and provides some great growth opportunities. Multiple sources of services, which is well spread, as you can see from that chart there. We're not reliant on any particular service level or source of work. The key drivers for growth over the next few years will be the significant insolvency capability, which will benefit from that market recovery we've discussed. So that's plant and machinery valuation and disposal, property receiverships, auctions and agency, our specialist insurance broker, which insures assets in insolvent situations, and the vacant property risk management expertise, which looks after vacant properties, again, principally in insolvencies, but not simply limited to that. We've got some excellent public sector growth opportunities. We've recently entered into a contract with the NHS for 3 years with a value of approximately 3 million to give them lease advisor expertise. We've continued to focus on the education sector with a 50% increase in activity in that particular area. And there are further opportunities for targeted organic growth moving forward. We've just been successful in joining the Crown Commercial Services tender list, which will enable us to tender for additional work from government departments. We have very strong relationships with banks and financial institutions, and that's being on their panels, both for new lending and also for recovery work. And there is an acquisition opportunity in what is a very fragmented marketplace. We have a pipeline of possibilities, and we expect to see this business grow by a continued combination of acquisitions and organic growth, which takes us on to slide 15. And our strategy, that balance of organic and acquisitive growth, which has been 50-50 over the last 5 years, as seen on a previous slide. In terms of organic growth, the focus is retaining and developing our existing partners and employees, making sure we look after them and they move forward in terms of their career with us. Recruiting new talent, principally from our competition. This is senior people who have an expertise and a following in the marketplace. Enhanced cross-selling of our service lines and expertise to a wider client base. An example of that would be MAF, that's just joined us, has already started to receive funding opportunities, both from the insolvency business and from our property services division. And in addition to that, investment in technology and process to enhance working practices and improve the services to our clients. In terms of the acquisition strategy, value accretive acquisitions in any of the following market segments. In terms of insolvency, to increase our market share, as we've seen with CVR and DRP. For property services, to enhance expertise or geographical coverage. Our recent acquisition of HNG added to our valuation practice in London the expertise of agency and lease advisory. And complementary professional service businesses to continue the development of the group and its service offering. An example of that, of course, is the MAF finance brokerage. To summarise, a strong position, and we're confident in our outlook for the future. Significant increase in scale of the group and capabilities. Recovery and advisory business is well placed to continue the recent track record of growth, scheduled to start in September, but we have started to see some of that coming through already, we believe, although it's early days to say. We're well placed to service an increase with increased scale and capabilities and also capacity. We carry spare capacity in anticipation of that upturn in activity. The property business is well placed to deliver growth. Those early pandemic setbacks that Nick mentioned are behind us now, and the business is operating very effectively. We're in a strong financial position to finance future organic and acquisitive growth. And there'll be a further update on activity levels at the AGM in September. So to summarise in one line, the benefit of acquisitions and organic growth leaves the group well positioned to deliver anticipated material growth in earnings in the new financial year. Thank you for listening, and if there are any questions, we'd be delighted to take them now.
And we have a question from Rachel May at Shorecap, who asks, how high do you think margins could go within the business recovery division if volumes return to pre-pandemic levels? Closer to 30%?
Well, I guess in one word, Rachel, yes. So I think we've seen that in the past in terms of margins in recovery. We've seen good improvements as we've had the increase in scale over the course of the last couple of years. And I think as we see larger cases coming through where the margins tend to be better and people are busy with a good portfolio of cases, then we would expect to see that move forwards in those sorts of conditions.
Thank you. We'll go to Samuel Dindal from Stifel.
Morning, guys. Firstly, on M&A in your balance sheet, so end of the year of net cash, can you just sort of remind us what balance sheet you'd be willing to run with and how much headroom that would give you for further M&A? And then secondly, on the insolvency market, I guess the million-dollar question, does it rebound to sort of the 10-year run rate, let's say 18,000 cases a year, or do you think there'll be a spike in H2 and then it will settle? How do you think that will sort of play out?
Well, in terms of bank facilities where we're comfortable using those both for working capital and M&A, we would be happy with once or 1.5 times covered, which of course, given the projected profitability for what is now the current year, would use up, Nick, I'm right in saying, most of our facility. Of course, at the year end, we were sitting in a net cash position. So we think it's unlikely we'll get anywhere near that 1 to 1.5 times covered over the course of the next year, despite the fact that we have got acquisitions that we would hope to complete. In terms of the insolvency numbers, we anticipate an increase in activity, as we've said. We were tracking up towards high teens before the pandemic struck. Certainly the trajectory was up at that stage, partly on the back of uncertainties with Brexit and lack of investment over the years since the referendum and Brexit actually happening. So we anticipate the numbers will be into the 20s, and we think they'll be that sort of level probably for at least a couple of years. So we'll see a prolonged level of activity. Nonetheless, there are many businesses which have benefited from the support measures, who are in a relatively strong position, and in some industries demand will come back strongly. So we think that we could well be seeing almost a two-tier economy, with those businesses which have got significant headwinds really struggling, and other businesses actually taking the opportunity to move forward very strongly.
And we've got a question from James Fletcher from Sencos, who asks, have you seen any evidence of smaller competitors struggle given the decline in appointment volumes? And has it made potential acquisition targets more willing to talk?
Yes, we have. We think the major impact has been on the smaller firms. We have obviously, as we've said, we've more than increased our market share, and value-wise, we remain flat. And we look at our major competitors who seem to have been successful in winning work. So the smaller firms have suffered, and in some respects, you're right. We're seeing them looking for cover. So we're having a number of conversations at the moment with businesses which have had a tough 12 months and would just now rather be part of a larger organisation and the infrastructure that gives them. With others, of course, it means that they think now is not the right time to sell because their business has not done well over the last 12 months and the financial performance reflects that. So they'll perhaps be waiting for another couple of years to build up the business again and build up the work on the shelves before they start having a conversation.
Thank you. We'll go to Andy Edmond at Equity Development. Andy, go ahead.
Yeah, morning, gents. Just a couple of questions. Firstly, on offshore, and you mentioned the benefit of the acquisition and the Gibraltar lead. Do you have high hopes of further work coming from external centres?
In terms of the offshore practice, yes, very much so. And the link into London, where we have that significant scale now, is a very good link, because there are many jobs which are actually UK based or sourced out of the UK that have those significant implications in offshore locations. So we would hope to see a flow of quality work, probably done mainly out of our London office as a result of having those offshore locations. And indeed, it may well be we see the number of locations start to increase over the next year or two.
Okay, thank you. And then in terms of the nature of the acquisitions, we very much realise that it takes two to tango, and opportunities you can wait many years for, and the vendors will only come to you at a certain time. But the big transactions in 21 have been in the counter-cyclical side. How much are you just keeping an overall view on the balance of revenues within the group to keep it performing through the entire cycle?
Well, very much we'd like to have a balanced business in the medium term, but it's also taking advantage of opportunities when they come along. So certainly the CVR and DRP opportunities were too good to miss, two excellent practices of a scale and size that is very rare in the UK market. So we were very keen to take those on board. And I think in terms of timing, that's pretty good as well, because of our anticipation of increased activity over the next few years. But we're also looking at property-related acquisitions of significance, and we're also looking at other professional services areas. So we'd expect to see over the whole of the cycle roughly a 50-50 balance between cyclical and counter-cyclical businesses.
And that's the end of questions. Rick, do you have any closing remarks?
Well, I would just like to thank everybody for joining us today. And just to reiterate, we're very pleased with the performance for the last year. And we're looking forward to that material increase in activities in the current year on the back of a busier marketplace and the excellent acquisitions that we've made in the first half of calendar 21. So thank you again, everybody.